fundamentals in our 28th year in business. It's Thursday morning, July 20th, 2017, and the title of this week's audio blog is The State of the Monetary Union, Today and Tomorrow. Now, it's 3 o'clock a.m. as I start, and until I woke, I had no clue what I'd discuss. However, in viewing the 7 pages of notes from the past 24 hours alone, let alone after tonight's Bank of Japan confirmation of what I discussed at length yesterday, i.e. its complete surrender to deflation, I decided to update last June's audio blog number 150 in this audio blog number 202. A year ago, the inspiration for "It's official, central banks are dead, and here's the real end game" was twofold. One, the Fed seemingly, at the time, Bank of Japan-like surrendered to deflation at its June 2016 policy-setting meeting, which it subsequently modified as part of the historic market manipulation and propaganda scheme that commenced the day Trump pulled off his Brexit times 10 victory on Election Day, only to remodify last week when whirly-bird Janet unexpectedly, even to me, gave her ding-dong the Fed is dead speech at last week's Humphrey Hawkins congressional testimony. And two, Bitcoin's coming out party around the time of last year's halving event, i.e. when the amount of mined Bitcoin each 10 minutes was halved for roughly the next 4 years, from 25 to 12.5. A month earlier, I had penned my, at the time, shocking new view of the monetary future, precious metals and Bitcoin, twin destroyers of the fiat regime. And a year later, I more than ever believe that history's largest, most destructive fiat Ponzi scheme is amidst its terminal stage, ahead of a monetary reset that will shape the future for generations to come. And by reset, I don't mean one determined by a room full of central bankers and politicians, but by the will, as represented by inevitably unfettered market movements of the billions of global denizens comprising the monetary majority. That said, before I get to today's State of the Monetary Union, today and tomorrow, I want to go over said 7 pages of notes to A, remind you how rapidly the conditions leading up to these changes are approaching, and B, prep your mind for a new monetary view. Starting with the aforementioned Bank of Japan meeting, which, as discussed in yesterday's Holy Grail Bullish Silver Statistics article, validated the whisper rumors that its long-standing, comically arbitrary, patently useless, and statistically rigged 2% inflation target would be abandoned. To wit, not only were the negative 0.1% interest rate, the 10-year JGB or Japanese government bond target rate of 0.0%, and the 80 trillion yen annual QE targets maintained, but the fiscal year 2019, as in ending March 2020, GDP forecast was reduced to 0.7%, with the risk, quote, skewed to the downside. And for the coup de grace, said 2% deflation rate was, quote, delayed to around fiscal year 2019, due to its assessment that, quote, inflation expectations remain in a weakening phase. In other words, with Shinzo Abe's approval rating down to a record low 29% after 4.5 years of the Abenomics hyperinflation scheme that was proposed to last just 2, and Haruhiko Kuroda, like Janet Yellen, at risk of not being reappointed as central bank chairman early next year, the BOJ decided to double down on its monetary lunacy at a time when the global economy is weakening, but the yen has not been able to weaken further against Janet Yellen's own printing press suppressed toilet paper. I mean, why stop at owning 71% of all listed Nikkei equity ETFs when you can shoot for 100%? This mere hours before Goldman Mario is scheduled to deliver the ECB's latest monetary verdict, which in true U.S.-like truth speak is being propagandized as potentially hawkish for the same nonsensical reasons that anyone would believe the Fed, Bank of Japan, or any major central bank would speak, let alone act in such a manner, at a time when the global economy is historically weak. Not to mention, after the euro has surged due to Yellen's final currency war salvo, making it that much more difficult to achieve the inflation he so desperately seeks. Remember, it was just 1 month ago when the hawkish ECB hype reached fever pitch, before Draghi, too, delivered in historically dovish surprise. Not that any of this idiocy matters a whit, as at this point, central bankers' point of no return is so far in the rearview mirror, the potential for any policy even remotely responsible, let alone effective, if their true goal was stable prices, is no longer recognizable. Generally speaking, fiat regimes always end the same way, as whether one is discussing monetary policy or Madoff-like investment pyramids, they will always be Ponzi schemes that must grow exponentially to survive, with the minor catches that inevitably they wilt under their own weight, and confidence must be maintained in what they are doing, lest the fraud collapses instantaneously, just has been the case all 1,000 plus times fiat regimes have been attempted, which fortunately will never again be allowed to commence once this one does, on a grand scale, amidst a world drowning in $200 plus trillion of debt, what the previous 1,000 plus have. Back to the PIMBEEB, or precious metal bullish, everything else bearish headlines that make me so sure of this, which with each passing day accelerate my expectation of said reset from the realm of inevitability toward that of imminence. Let's start with Megan Wells' shocking research about U.S. household debt, which, if you recall, earlier this year surpassed the prior peak in, drumroll please, 2007, just before history's largest financial collapse. And when I say shocking, I'm not being hyperbolic, as there is simply no way to react otherwise to the fact that the average household has $176,000 of mortgage debt, $17,000 of credit card debt, $29,000 of auto loans, and $50,000 of student loans. The fact that two-thirds of households have little if any savings, or that the cost of healthcare, rent, education, and childcare are at record levels, deflation notwithstanding, or that mortgage service costs at a whopping 23% have never been higher as a percentage of real disposable income. One, because a decade of zero-cost money, which should theoretically make the cost of serving it go down, not for you, but the 1%, has caused an epic real estate bubble, which has, two, driven up housing and rent prices to record highs, amidst, three, the direct result of such policies, the worst economic environment of our lifetimes. I mean, how much more proof does one need that Americans are desperately attempting to make ends meet then, after interest rates declined a mere 10 basis points following Janet Yellen's historically dovish speech last week? Refinancing applications surged by a whopping 13%, which fortunately for said 1% has produced equity and fixed income valuations so egregious and so disjointed from reality, they're starting to put to shame those of history's biggest financial bubbles, from tulip mania to the dot-coms. Only this time, the inflation of financial assets is decidedly not being driven by the masses, who cumulatively have never been in worse shape, but the 1% receiving the free money and government market support boost, which in turn has driven the historic wealth inequality that resulted in Trump's election victory, yielding heightened political and geopolitical instability, and inevitably the draconian government actions, like soon-to-be enacted civil forfeiture laws, that will unquestionably hasten the end of the dollar's rapidly dying reserve currency status. Trust me, it's no coincidence that the BRICS gold marketplace was officially launched this week to enable the settlement of formerly petrodollar-settled energy transactions between China and Russia with gold. Just as Russian gold purchases accelerate, Chinese gold imports explode, and even Indian gold and silver imports do the same, as clearly the fears of an Indian gold ban, which if it actually occurred would inevitably be overwhelmed by surging black market activity, were just as much driven by propaganda as the now 4.5-year common knowledge of the tightening cycle the Fed never commenced, and, as evidenced loud and clear by Whirlybird Janet's speech last week, never will. Or that the comics commercials have been covering shorts more rapidly than at any time in the past 15 years, aided by the Fed's already proven to be fraudulent hawkish hike in late June, enabling the cartel's July 4th holiday week raid, which following the past 2 weeks' massive short covering has been completely reversed and then some. This, as the Bitcoin scaling debate has reached a crescendo that could result in a resolution within weeks, which, if it does so favorably, will drive additional currency from the dying fiat swan, in turn putting heightened pressure on a cancerous regime already in an historically vulnerable position. And by historically unfavorable, I mean they are now being forced to resort to a Bank of Japan-like market manipulation scheme, with the only difference being that, for the time being, America's unprecedented manipulative machinery has caused the calm in the form of record low volatility that has enabled the Fed, President's Working Group on Financial Markets, and Exchange Stabilization Fund, not to mention the gold cartel, to operate covertly, as opposed to overtly in Japan, Europe, and even China. And not just in the financial markets realm, but economic data, which despite being as weak as at any time since the height of the 2008 crisis, has never been more blatantly rigged. To that end, what's more fishy than plunging U.S. energy inventories whilst simultaneously it's being reported that production hits a record high and demand plunges to multi-year lows? Perhaps housing permits' sharp June rebound will simultaneously home builder confidence, which traditionally is amidst the most upwardly biased indicators imaginable, is reported to have plunged to an 8-month low. And did I mention that little old thing known as Trumpflation? You know, the fraudulent meme fabricated mere hours after his Brexit times 10 victory, in which stocks, bond yields, commodities, and the dollar should all rise, whilst gold and silver, of course, should decline, due to the guarantee that he'd produce a repeal and replace of Obamacare, huge tax cuts, massive fiscal stimulus, a dramatic reduction in regulations, and reduced military entanglements. Just 9 months later, not a single one of these criteria have been met. And economic data, upward goosing notwithstanding, is at its weakest since the 2008 financial crisis. In other words, the only achievement of the post-Trump era has been dot-com valuations in a Great Depression era. Not to mention the lowest inflation-adjusted precious metal prices of modern times, if not ever, at a time when not only is the sheer weight of such dislocations threatening to collapse the illusion like never before, but the amount of potential black swan disruptions have never been more plentiful. And I haven't even brought up the debt ceiling debate, which promises to go into hyperdrive once Congress returns from the month-long recess it plans to irresponsibly take with so many pressing issues unresolved. As if anything would get done if they worked 24/7. Yes, the $19.9 trillion debt ceiling, which, if not for the massive fraud euphemistically known as extraordinary measures, i.e. the federal government borrowing from public pension funds and other horrifyingly unethical accounting gimmicks, would be well over $20 trillion by now, and will be the second a new debt ceiling increase is approved, likely to at least $22 trillion by no later than the mid-October deadline when the government's cash balance will run dry. Then again, given how historically dysfunctional Washington has become, not just Democrat versus Republican, but within the Trump administration itself, not to mention the potentially hyperinflationary ramifications of approving a $22+ trillion debt ceiling just 6 years after the U.S. was stripped of its AAA credit rating for breaching a $14 trillion debt ceiling, my base case scenario assumes a bloody, heavily publicized political conflagration that could tear Washington apart, and with it the historic valuation anomalies history's most destructive, blatant market manipulation efforts have created. With all that happy talk in mind, let's move on to today's State of the Monetary Union update of where we are today and where I expect it to go, which, per all I have discussed today, and hundreds of days before it, has nowhere to go but down, as history's largest, most destructive fiat Ponzi scheme races through its malignant terminal phase. A year ago, the Fed was far more sanguine about the economy than today, which in hindsight simply adds to their legend of over-optimistic cheerleading, despite the historic economic data rigging and market manipulation utilized to justify their since disproven beliefs. However, Whirlybird Janet's ding-dong the Fed is dead speech last week, supplemented by Haruhiko Kuroda's equally uber-dovish assessment this morning, and wow, as I write, the ECB's unexpected commitment to, quote, extend QE in terms of size and or duration if the economic outlook worsens or financial conditions become inconsistent with further progress toward a sustained adjustment in the path of inflation, not to mention the PBOC's historically reckless acts to reflate China's dying economy, provide a cumulative mosaic of central bank surrender, even as they, of course, continue to put on their bravest face. However, the facts of plunging interest rates, stagnating commodities, weak economic data, and a rapidly weakening reserve currency, this as precious metals continue to resist the cartel's best manipulative efforts, given surging physical demand, suggests it won't be long before the world's hyperinflationary ringleader, the Federal Reserve, is forced back into the overt hyperinflationary arena. The only question being, what will catalyze the crisis that bursts, even modestly so, the historic bubbles that have been created by unprecedented market manipulation? Irrespective of what causes it, the when is getting closer with each passing day. And once the realization of the Fed's increasingly obvious inability to either forecast or counteract the crashing economy it created starts to spread, confidence in its viability will be called into question, as is already the case for essentially all non-reserve currency issuing central banks. That said, even in the past year, it has been utterly astonishing to watch not only the terrifying cyclical headwinds accelerate, but the pace of secular changes that threaten, as never before, the dying 1% protected status quo. From the symbolic dagger to the powers that be's increasingly comical job market strength meme that the Amazon-Whole Foods merger represents, or Amazon Prime being on the verge of exceeding all cable television subscriptions, to the exploding student and auto loan delinquencies that will put the system's historically vulnerable, parabolically rising debt load at risk of collapse, to the dramatic currency market ramifications of what will shortly be an openly dovish Fed, let alone one that will see its entire management team replaced by the, quote, low interest rate people Trump desires, which no doubt will be turbocharged by a potentially historic debt ceiling battle, to the potentially surging adoption of Bitcoin, whilst the gold cartel's obviously diminishing firepower risks being overwhelmed by surging physical demand, the potential for the second half for the world to have dramatic monetary ramifications, both presently and for the future, is as strong as at any time in modern history. Ultimately, I believe fiat currencies are on their last leg, as a status quo of inefficiency, destruction, and feudalism is replaced by one with a majority rule at the behest of the minority. In other words, just as the positive means we have grown up with, of supermarkets, landlines, neighborhood banks, shopping malls, and cable television will be uprooted and discarded, yielding, I might add, historic debt defaults, unemployment, and government borrowing, the negative ones will be destroyed too. In my view, which I first discussed a year ago, and today believe more strongly than ever, is that the future of utilitarian, day-to-day monetary transactions is cryptocurrency, which, although not guaranteed to be anchored by Bitcoin, likely will be. The road to universal adoption will be bumpy, but given the combination of fiat currency destruction and cryptocurrency technological advancement, it might take far less time to achieve than most can imagine, which, per last year's precious metals and Bitcoin, twin destroyers of the fiat regime, will undoubtedly cause governments to all but abandon their increasingly futile efforts to suppress gold and silver prices due to the new expedited top priority of quashing Bitcoin, which, given its inherent nature, will undoubtedly prove futile, even if a few battles are won along the way. However, ultimately, I believe that trying to stop a global, decentralized, internet-based money, assuming it scales, which with each passing day appears a more and more likely scenario, will be the equivalent of Don Quixote flailing at windmills. Just as a massively weakened gold cartel will be, when not only is its attention diverted by Bitcoin, but the physical supplies it requires to prevent the massive historic price revaluation that must inevitably occur run out. Well, that should be enough to digest for now. Clearly, the world is changing in every manner possible, at a rate never before seen. And nowhere is it more ripe to change, for the better, than in the monetary realm, where the inevitable and perhaps imminent destruction of history's largest, most destructive fiat Ponzi scheme ushers in a brave new world where, per my May 23rd article, Decentralization, the Future of Monetary Value, transactions are conducted in non-government issued currencies, and wealth preservation is anchored, along with Bitcoin, by the asset class that has successfully provided this function, irrespective of dozens of failed suppressive efforts for the past 5,000 years, which care of the latest and most virulent of such schemes, the New York gold pool, are now more undervalued than at any time in modern history. To that end, the need to protect yourself from what's coming, financially and otherwise, has never been more urgent. And if your desired protection prescription is precious metals, particularly if you seek the best possible storage options, we humbly ask you to call Miles Franklin at 800-822-8080, or go to milesfranklin.com and register for online purchasing, and give us a chance to earn your business. And as always, I can be reached by email.